week is about to reach its end as we open next week's calendar. On the monetary front, we know that the Turkish Central Bank and the ECB are set to release their interest rate decisions on Thursday, followed by ECB President Lagarde's press conference on the same day. In terms of financial releases, we make a start on Monday with China's trade balance figure for September. On Tuesday, we get the UK's employment data for August, Sweden's CPI rate for September, the Eurozone's industrial production rate for August, Germany's ZEW figures, and the US New York Fed manufacturing figure, both for October, and ending of the day with Canada's CPI rates for September. On Wednesday, we get New Zealand's CPI rate for Q3, Japan's machinery orders rate for August, and the UK CPI rate for September. On Thursday, we get Japan's trade balance figure and Australia's employment data, both for September, followed by the weekly US initial jobless claims figure, the Philly Fed Business Index figure for October, and the US retail sales rate for September. Lastly, on Friday, we get Japan's CPI rates, China's urban investment, industrial output, and retail sales rates, all for September, followed by China's GDP rate for Q3, and ending of the week is the UK's retail sales rate for September. For the US, on the monetary front, we note the release of the FOMC September meeting minutes, in which Fed policymakers appear to be shifting their attention to the second part of their mandate, which is full employment, as the committee has gained greater confidence that the inflation is moving sustainably towards 2% based on the FOMC's minutes. Moreover, the recent financial releases, such as the US employment data, came in better than expected, implying a resilient labor market, and thus appears to be amplifying calls for a gradual easing cycle rather than an aggressive approach by Fed policymakers, which in turn may have aided the greenback. Moreover, the release of the US CPIs for September, which were released yesterday, appear to have anchored market expectations of a 25 basis point rate cut by the Fed in their next monetary policy meeting, after coming in slightly hotter than expected at 2.4% on a year-on-year basis and 0.2% on a month-on-month basis, versus the expected rate of 2.3% and 0.1% respectively. In particular, Fed funds futures currently implies a 93.3% probability for such a scenario to materialize. On the fundamental level, we note that Hurricane Milton has made land on Florida, and the true economic impact on the state is yet to be seen. In addition, on a political level, the US presidential election is heating up, and with 25 days to go, it appears that the office of the presidency of the United States is still up for grabs. For the UK, in terms of monetary policy, we note that significant announcements were made by BOE policymakers over the past week. In addition, from a macroeconomic perspective, the Halifax house prices rate for September came in higher than expected, which may imply that demand for housing appears to be on the rise, and thus may infer that the UK economy is holding up despite the relatively high interest rates. However, pound traders may be interested in next week's financial releases, as the UK employment data for August and CPI rates for September are set to be released. Therefore, should the employment data showcase a resilient labour market, it may provide leeway for the BOE should they wish to adopt a more gradual rate-cutting easing approach and thus potentially aid the British pound. Whereas, should the employment data imply a loosening labour market, it may force the BOE's hand to cut interest rates more aggressively, which could weigh on the pound. In addition, the same scenario applies for the UK CPI rates, where should they imply persistent inflationary pressures, it may aid the pound and vice versa. For Japan, on a fundamental level, we note that Japan's newly appointed cabinet is already being judged by the people for editing an official photo. The issue may appear immaterial, yet is a reminder that the new government will be closely monitored and any actions made will be looked at with a microscope. On a monetary level, we would like to note BOJ Himino, who stated that if the outlook for economic activity and prices presented in the July report are achieved, the BOJ will accordingly raise interest rates. Thus, the apparent contradiction of BOJ Governor Ueda's comments last week appeared to be enhancing the prospect of a hawkish BOJ. Thus, the prospect of an increasingly hawkish BOJ may aid the JPY in the coming week should more BOJ policymakers adopt a similar tone. In terms of financial releases for JPY traders next week, we'd like to note Japan's CPI rates for September, which are due on Friday. Should the CPI rates further enhance and showcase that the bank is on track to achieve 2% inflation in a sustainable manner, it may aggravate calls for further rate hikes by the BOJ, which may aid the JPY. On the flip side, should the aforementioned scenario not materialize, it may increase pressure on the BOJ to withhold from raising interest rates, which in turn may weigh on the JPY. We make a start for Euro traders with ECB board member Kazak's comments that if inflation in the next year really returns to a sustainable 2%, interest rates may have to be on a more neutral level. Furthermore, the ECB's September's monetary policy meeting minutes showcased that ECB's chief economist Lane proposed that, looking ahead, a gradual approach to dialing back restrictiveness would be appropriate if the incoming data were in line with the baseline projection. Overall, the ECB's minutes, in addition to ECB policymaker Kazak, tend to imply that the ECB may be poised to continue on their monetary policy easing cycle in their meeting next week. In particular, the majority of market participants currently expect the bank to cut by 25 basis points, with Euro OIS currently implying a 98.5% probability for such a scenario to materialize. Hence, attention may turn to ECB Lagarde's press conference following the decision, where should she imply that the bank will continue cutting interest rates, it could weigh on the euro. On the flip side, should ECB President Lagarde showcase a desire by policymakers to refrain from cutting interest rates in the near future, it may have the opposite effect and thus aid the euro. On a macroeconomic level, we would like to note Germany's ZEW economic sentiment figure for October, which is due on Tuesday. Should the figure come in lower than the prior reading, it may imply that confidence from the consumer side in the German economy may be worsening and thus may weigh on the euro given the significance of the German economy in the eurozone, and vice versa. We make a start on a macroeconomic level for Australia by noting that no major financial releases occurred during the week and that traders may be more interested in the employment data for September, which is set to be released next Thursday. In particular, we would like to emphasize the unemployment rate, which, should it come in higher than the prior reading of 4.2%, it may imply a loosening labour market, which may increase pressure on the RBA to cut interest rates in their next meeting. Whereas, should the unemployment rate tick downwards, it may imply a resilient labour market, which in turn could increase pressure on the RBA to hike interest rates. Overall, the release of the nation's employment data for September next week takes on an even greater importance due to the release of the RBA's last meeting minutes this week, in which the board discussed both possibilities of raising and cutting interest rates, and thus the employment data may play a crucial role in the bank's decision during the next monetary policy meeting. Furthermore, given Australia's close economic ties with China, traders may be interested in China's GDP rate for Q3 and industrial output rate for September, which are due out on Friday. Hence, should the financial releases imply a resilient Chinese economy, it may translate into a stronger Australian dollar and vice versa. CAD traders may be interested on a fundamental level on the path of oil prices, given the status of Canada as a major oil-producing economy. Hence, on a geopolitical level, should tensions in the Middle East increase, and even further, should oil-producing facilities be targeted in a retaliatory strike from Israel against Iran, it could provide support for oil prices and, by association, the loonie. We would like to highlight that Canada's employment data for September is set to be released later on today. Therefore, should the data show a tightening Canadian employment market, we may see the CAD getting some support, as the data would allow the BOC not to expedite its rate cutting path, while a widening of the slack in the Canadian employment market could add more pressure on the BOC for faster rate cuts and thus weigh on the loonie. For next week, loonie traders may be interested in the release of Canada's CPIs for September, which, should they showcase a further easing of inflation pressures in the Canadian economy, it may weigh on the CAD. Whereas, should the CPI rates come in hotter than expected, it could provide support for the loonie, as it may increase pressure on the BOC to gradually rather than aggressively ease their monetary policy stance. As an epilogue, we would like to make a comment for the situation in the Middle East that is still tantalizing the markets. The possibility of Israel targeting and destroying Iranian oil infrastructure, such as the Kark Island, a major Iranian oil export hub, are still in play. In such a scenario, we may see oil prices getting a substantial boost as market worries for the supply chains and a subsequent tightening of the international oil market could intensify further. In the US equities markets, all three major indexes appear to be on track to end the week in the greens. We would also like to note that earnings season has begun once again, with Citigroup, Morgan Stanley, Goldman Sachs and Rio Tinto, amongst others, which are expected to release their earnings reports next week. From all of us here at IronFX, thanks for tuning in.
Okay, let's go ahead and get started. So as per usual, a risk warning and disclaimer. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you fully understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. I'm Melanie, and I will be a speaker for today. I'm an investment analyst at Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Here's our agenda for today. We're going to start off by talking about some fundamental trading strategies. Then we'll talk about the top 10 cryptos, what their value propositions are, where you can keep up to date on their developments, and trading their cryptocurrencies. Okay, so let's go ahead and get started. So one of the first mistakes that people have when it comes to fundamental trading is not having a trading plan. So having a trading plan is important for a couple of reasons. Firstly is consistency. So a trading plan helps you to maintain consistency in your trading approach. It outlines your trading strategy, including your entry and exit criteria, risk management rules, and position sizing. So by following a well-defined plan, you're less likely to make impulsive decisions based on emotions or market noise. Consistency is crucial for long-term success in trading, as you would know. So having a well-defined trading plan helps you to maintain that. Next is objective decision making. So a trading plan provides a framework for making objective decisions. So it helps you to define specific criteria for entering and exiting trades based on technical or fundamental analysis. So this kind of eliminates the guesswork and emotional biases that you might have when it comes to trading and allows you to make more rational decisions based on your predetermined rules. Number three, risk management. So we'll go through a couple of risk management tools in a little bit, but risk management basically is really important, as you would know, since it helps you to protect your capital. So having a trading plan that incorporates your risk management basically outlines how much risk you are willing to take on with each trade, where to set your stop loss orders, and when to take profits. So by implementing proper risk management techniques, you can limit your potential losses and preserve your trading capital. Next is focus and discipline. So a trading plan keeps you focused on your focused on your trading goals and prevents distractions. So it helps you to avoid impulsive trades and chasing after hot tips. So following a plan requires discipline and adherence to the rules that you've set for yourself, and this discipline is essential for overcoming the emotional challenges that come with trading. Evaluation and improvement, that's pretty straightforward, I think. Basically, keeping a record of your trades and comparing them with your plan can help you to identify any strengths and weaknesses in your trading strategy. So this can allow you to continuously improve your trading approach over time. And lastly is confidence. So a well-defined trading plan gives you confidence in your trading decisions. So with a structured framework and a set of rules to follow, it can help you to reduce uncertainty and anxiety. And obviously increase your confidence as well. So you're more likely to stick to it during challenging market conditions and avoid making impulsive or emotional decisions. Another mistake that some people have is not having a risk management strategy, which we mentioned earlier. So one of the most basic risk management strategies that we follow is proper stop loss and take profit placement. So the proper stop loss and take profit placement is important to ensure that you maximize your wins and minimize your losses. So your stop loss should be placed beyond your resistance area, while your take profit should be placed before. Okay, so in this example, you can see we're going in for a sell, which is why our take profit is placed below. So here in this image, right at the bottom, you can see that's a scenario where we're going in for a buy. So your buy entry, we're going in for buy, we'll place our take profit on top, but below your confluence. Fibonacci confluence will be placed, your stop loss will be placed below that. So it's basically the opposite. So the reasoning behind this stop loss and take profit placement, let's start off with a stop loss is basically that you should always put your stop loss beyond a key Fibonacci confluence area. And when we say Fibonacci confluence area, we are talking about areas where two or more Fibonacci levels line up. But even more important than that, this applies for any major resistance areas. So it could be like your pullback overlap areas, Fibonacci of even your pivot point levels. As long as you have a strong resistance area, this applies as well. So the reason for this is because more often than not, price tends to get attracted to such strong areas of confluence. And if your stop loss is right before instead of beyond it, you'll most likely get stopped out before your market reverses. So that's also one of the reasons why most people wonder why they got stopped out right when the market starts to reverse, and then they start complaining about stop hunting. Next is your take profit should be placed before, which means that you should always place your profit target before a key resistance or confluence area. Reason for this is because when price reaches that confluence area, there's a high chance that it won't be able to go beyond it. So instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. And this is one of the reasons why people complain that the market is being manipulated, because they missed the take profit by 1 pip. So here's another risk management strategy, which is break even. And break even in trading basically refers to the point at which a trader reaches a level where he has neither made a profit nor suffered a loss. So it's the point where the cost of the trade, including fees and commissions, is equal to the price at which the trade was executed. So for example, if a trader buys a stock at $100 and sells it at $110, the trader has made a profit of $10. On the other hand, if the trader buys a stock at 100 and sells it at 90, the trader has suffered a loss of $10. So in this example that I'm giving you guys, we're talking about stocks, but this applies for any kind of trading, any kind of security or asset as well. So if the stock is sold at $100, since that's the price that he bought, he has neither made a profit nor suffered a loss and has reached its break-even point. So that's kind of the idea behind it. So what does it mean when it comes to trading? So it's basically the level where you are in profit and recognize that there is a risk of reversal back to your entry. So here we have an entry at the breakout of the multiple swing high resistance level, where we are hoping for price to push to our take profit. So take note of our original stop loss at number 2, and that's in line with a swing low support. At point 3, price reaches our break-even level and reverses off of it. Hence, we move our stop loss to the entry to protect our position. So if price continues to our position, that's great. As in, if it continues moving to our take profit, then that's obviously a good sign. But if it reverses back to our entry, we want to be protected. So here we can see price has broken above the break even, but quickly reversed and hit our stop loss. Okay, so another risk management strategy is partial profit. So partial profits basically refers to the practice of closing only a portion of a trade when it reaches a certain profit target, while leaving the remaining position open in order to potentially capture further gains. So the idea behind partial profits is to lock in some of the gains while giving the remaining position room to potentially continue to move in the desired direction. So, for example, if we go back to that example of stocks, so if a trader buys 100 shares of a stock at $100 and the stock rises to 110, the trader might choose to sell only 50 shares, taking a partial profit of $500, and the trader would then still have 50 shares that are now worth 550. So then he could potentially continue to make profits if the stock price continues to rise. So this basically is typically used when there is a strong resistance area and you are kind of unsure if prices will continue to rise to your take profit. So that's kind of the idea behind this risk management strategy. Okay, so here's our partial profit example. Here you can see that we have a pretty strong resistance area at our partial profit that's in line with 38.2 Fibonacci retracement and a 78.6% Fibonacci projection. Okay, so we're unsure so our first support here is our buy entry, and we're expecting prices to rise to our take profit. But there is a strong resistance at the Fibonacci confluence area, which is this level that we mentioned earlier. So we're unsure if prices are going to be able to push past it. Okay, so as a matter of fact, price reacted off that strong resistance area at our partial profit and reversed off of it instead of heading to our take profit. Okay, so you can see we got out of that trade before prices started heading back downwards and we got out with a partial profit. Okay, let's look at our break-even placement example now. So in this example, our entry is in line with a 100% Fibonacci projection level. Prices currently are moving towards it, and we're expecting prices to reverse of our entry and hit towards our take profit. So now we go in with a couple of Fibonacci levels, and we notice that there is a Fibonacci confluence area right in the middle between our entry and our take profit. So this level is in line with a 23.6 retracement and the 30.2 retracement as well. So this confluence area, we're unsure if prices are going to be able to push past it towards our take profit. And it's also the level that we've identified where prices are where we would make a break even. So you can see prices have now reached our break even. So what we do is move our stop loss adjust to our entry to minimize losses, and so that we prepare ourselves for this in the event that this happens, which basically prices are not able to push past our break even and prices reverse off of it and hit towards our stop loss. Okay. Let's talk about idea invalidation now. So idea invalidation basically is another risk management strategy. Let's start off by talking about what it is first. So in trading, the idea of invalidation basically refers to the process of evaluating a potential trade idea and determining if it should be disregarded or acted upon. So essentially, it's a way of determining if a trade idea still holds up in light of new information or market conditions. So here's how the process of idea invalidation typically works in trading. Firstly, you have the initial trade idea. So the trader has kind of an initial idea about potential trade based on the analysis of the market conditions, technical indicators, etc. And then followed by the evaluation of the idea. So looking at the current market conditions and other relevant info like economic data, you then determine if the initial trade idea still holds. Then you come up with your invalidation criteria. So the trader then establishes criteria for invalidating the trade idea, such as specific price levels or market conditions that would cause them to reconsider the trade. Next is monitoring. So you'll just monitor the market to see if the invalidation criteria are met. And lastly would be invalidation. So if the invalidation criteria are met, the trader will then choose to exit the trade or adjust their position. On the other hand, if the criteria are not met, the trader may continue to hold the position or add to it. So it's basically a crucial step in a trading process that helps traders make informed decisions about their trades and avoid potential losses. Okay, so idea invalidation is usually placed before your stop loss, and it's the level which you basically admit that you're wrong and that you want to get out of the trade ASAP. So when the level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So you can see in this example, we have point number one which is at our entry. Okay, and our idea invalidation is placed at this swing high level here, just below our stop loss. Our original take profit is placed before this support level with 3 swing lows, and we have a modified take profit once price breaks above our entry. You can see breaking above, and it triggers our idea invalidation. So earlier I mentioned our idea invalidation criteria. So that's basically what it looks like in the form when we are using it in technical analysis. So our idea invalidation here is the swing high, and prices have triggered our idea invalidation, which is why we've modified our take profit and we're moving it back to our entry. Okay, so if prices continue moving upwards, obviously you'll get stopped out, but you are hoping that with prices, or rather with our take profit moving up to our entry, you're hoping that this gets us out of a losing trade. Okay, so this is what it'll look like in an actual chart. Okay, this slide first. So you can see here, we are starting off with our entry, with prices heading towards our entry at the swing low. We've then placed our take profit at this overlap level that's in line with a 50% retracement. Okay, and you can see here the 50%, we have two 50% retracements that line up with our take profit. And we also have a 127.2 extension level that lines up with the minus 27.2 expansion level as well. And that's also in line, sort of in line with this swing low here. I mean, it's kind of beyond it. Okay, so we are expecting prices to bounce off of our entry and hit towards our take profit. Okay, but we've placed our stop loss below this confluence area, and we're placing our idea invalidation right on that confluence area. So that kind of forms our idea invalidation criteria. Okay, so prices do approach our entry, but they don't bounce off, and instead they break past it and hit towards our stop loss. Okay, so once our idea invalidation criteria is triggered, our take profit is then moved to the entry so that you get out of your trade ASAP. And you can see that's exactly what happened here. So we got out at break even. Okay, so it's a good thing that this happened, otherwise price would have stopped us out. Are there any questions so far? Okay, if there are no questions, let's go ahead and continue. So the next method that we're going to be talking about is your trailing stop loss. So trailing stop loss is basically a type of stop loss order that is set a certain percentage or dollar amount away from the market price. So the idea behind a trailing stop loss is to lock in profits while giving the trade room to breathe, as the stop loss follows the market price as it moves in favor of the trade. So going back to that example, let's say you buy a stock at $100 and you set a trailing stop loss at $10. So as the stock price rises to 110, the stop loss will follow, now at 110. Oh, sorry, now at $100. So if the stock price drops to $100, your stop loss will be triggered, selling your position and protecting your profits. So the trailing stop loss technique can be useful tool for traders because it allows them to manage risk and lock in profits dynamically as the market moves. So this is different from a fixed stop loss, which is set at a specific price and does not change as the market moves. So it's important to note that the trailing stop loss is not a guarantee that you will exit a trade at your desired price. It's just due to market conditions, it can trigger a stop loss order before it reaches your desired level, leading to an unexpected exit from the trade. So here are the different methods of trading stop loss that we're going to be covering today. First is our moving average. We have parabolic star, chandelier, ATR, support and resistance levels, and a combination of these methods. Okay, so let's get through them. Firstly, in this example, we are using our moving average. Our sell entry starts when prices break out of this ascending trend line, and also out of this overlap level. Okay, you can kind of see it breaking below this moving average as well. So now prices are moving below our moving average, and our trading stop loss is triggered over here. Okay, so trading stop loss is triggered, prices moving above our moving average, and we got out of the trade. Okay, so it got us out before this happened, before prices started to rise back to our entry. Another example is our trend line breakout. So here we have prices moving in. It's the same example, okay? We're just using different methods on the same chart. So here we have prices moving below our descending trend line. So again, similar idea. Once prices break out of that trend line, then we get out of the trade. Parabolic saw, you can see it's pretty much the same idea as well, with prices moving below your parabolic saw. That's also a signal that prices are moving in a bearish momentum. And once prices kind of break above it, that's a sign that the trend has changed. So got us out before the change in trend as well. Chandelier and ATR. So we have prices moving below. Kind of that same idea. Once it moves above, your ATR stop is triggered and your chandelier stop is also triggered. Okay. Are there any questions? Okay, let's talk about, let's do another example. So here we have a support and resistance levels. So we're going in for a sell entry. As you can see, prices breaking below that ascending trend line here. Okay. So prices are breaking below it, so we're going in for our sell entry towards our take profit below here. So we're going in with moving average. Prices are moving below the indicator, which is a bearish signal. Okay, and we got out at take profit before prices started to rise again. So here's just a very simple example of how you can combine your indicators with your support and resistance levels. Okay. Okay, so now let's talk a bit about what exactly is the FX News calendar. So it basically allows traders to see at one glance all important economic data releases, and it shows you key events such as your GDP, CPI, NFP, crude oil inventories, and even central banks' monetary policy meetings. So we have a few examples here of FX News calendars. On the left, we have investing.com, and on the right, we have forexfactory.com. So let's go through a few high impact events to understand what they mean and how they can impact the markets. We've gone through some technical strategies already, so it's important to be able to combine those with our fundamental events as well. So firstly, we have our FOMC meetings. The FOMC is your Federal Open Market Committee, and this is the US Fed's way of communicating their view on monetary policies. Next, we have the Fed interest rate decision that comes together with these meetings. So if the Fed is dovish, the USD is bearish. If the Fed is hawkish, the USD is bullish. If interest rate goes up, the USD is bullish, and if interest rate goes down, the USD is bearish. Okay, some employment data. If NFP is basically your non-farm payroll, this measures the change in citizens that are employed from the previous month, excluding the farming industry. And unemployment measures the total unemployment of workforce that is seeking active employment from the previous month. Crude oil inventories, these measure the weekly change in the amount of crude held by US firms. If crude inventories increase, oil prices should drop. EIA admin is a short-term outlook, the monthly forecast for the year ahead, demand and prices across major fuel types. Okay, some benefits basically, depending on your individual trading style, it helps you to plan and allocate trades for the day, week, or month ahead, helps to alert the individual to upcoming important news that might affect volatility. And yeah, so let's now jump into our crypto. So as of last year, in June, these were the top 10 cryptocurrencies. And this year, as of September, these are the top 10 cryptocurrencies based on market cap. So what are their value propositions? Basically lies in their unique characteristics and potential benefits compared to traditional forms of money and financial systems. Okay, so firstly, it would be your decentralization. Since it operates on decentralized networks, it provides individuals direct control over their funds and reduces the risk of censorship. Security and trust. It uses cryptographic techniques to ensure security and integrity. Also, because it's decentralized, it also offers varying degrees of privacy and anonymity. And borderless transactions. You're able to send and receive funds globally. And financial inclusion. So since these are decentralized, they don't rely on banks, So they have the potential to promote financial inclusion by providing access to financial services for the unbanked populations. Um, yeah, and some cryptos also support programmable smart contracts, which automate and enforce agreements as well. Okay, so of course, we all know the challenges and risks that exist, such as the volatility, the regulation, scalability, and environmental concerns. But of course, you can still keep up with crypto developments. And crypto Twitter, CoinGecko, which basically allows you to track activity rates and popularity of your favorite coins and tokens in one place. Project website is they usually have an attractive, user-friendly website that displays the features of the project. And news outlets, so you might be able to get some reputable crypto news outlets out there. Some form the backbone of what you see on crypto Twitter as well. Okay, so these are the most popular cryptocurrencies by far, by market cap. And how can you trade it? So you can trade it on traditional brokers such as your IronFX, crypto exchanges like Binance, Coinbase, and Kraken, and CFDs. So crypto coins, basically, there are a few differences between the coins and the CFDs. So crypto via exchanges provides access to other crypto services such as your DeFi and your NFTs. You can make cross-border payments without incurring third-party fees. Trading fees are often lower than traditional brokerages, but withdrawal fees are charged. You also have access to a wider range of cryptos, and exchanges are susceptible to hacks. CFDs, no withdrawal fees, and it allows traders to speculate on price movements of crypto without owning the underlying tokens. It also allows traders to capitalize on price movements without having to manage the process of securely buying and storing crypto tokens on exchanges or a ledger. Yeah, and you can open both long and short positions, and there's virtually no risk of attacks or hacks. Okay, let's go through some of the events for this week since we have time. Okay, so for today's, so we normally will look at forexfactory.com, but it's entirely up to you which economic calendar you wish to use. So this week, you can see I have it filtered only to look at the orange and red icons. And that basically is the medium to high impact events. But if you wish, you can also look at the yellow and gray icons, which are basically your low impact and non-economic events. So all of the events, oh, okay, oops, okay, thank you for letting me know. Okay, should be able to see now. So, okay, as I was saying, this is just forexfactory.com. Yep, thank you. Okay, yep, so you can change the calendar. It'll give you the really depends on your own trading strategy, but we normally just like to look at the upcoming week. So you can do that there. And you can see I have it filtered to only look at the orange and red icons, which I mentioned earlier are the medium and high impact events. If you click on this green icon, you can also look at the low impact and any non-economic events. So that will be your bank holidays. Event types, you can filter out any that you're not interested in or any currencies that you're not trading. I just prefer to look at all of them. And yeah, you can see that there are a lot of events to get through, which is why I normally just focus on the medium to high impact events. So for this week, on Monday, we had China's CPI and PPI. So both came out to be lower than forecasted. Tuesday, we have yesterday, we had UK's claimant count change, which was higher than forecasted. And average earnings index was lower than forecasted. And Canadian Gov Macklem speaks. Wednesday, which was today, UK's GDP came out to be lower than forecasted at 0.0%. And yeah, for the rest of today, we can expect US inflation data with the core CPI month-on-month and year-on-year data. Thursday, tomorrow, we will have US crude oil inventories, China's new loans data, Eurozone main refinancing rate, monetary policy statements, US core PPI, unemployment claims, and we have a ECB press conference as well. And in Switzerland, Chairman Jordan will be speaking on Friday, and the US 30-year bond auction will be happening as well. So, yep. We like Forex Factory because at one glance you can see all of the important news, especially the high and medium impact events. And you can also see the previous data, forecasted, and the actual data all at one glance. There are also some forums if you're interested in that. There are some news outlets as well. Yeah, there's some crypto forums as well in case you were curious on that. Yeah, I think that's kind of all I have for you guys for today. Yeah, if you guys have any questions, feel free to let me know in the chat. But if not, that's all for today. Thank you guys so much for joining me. I hope you guys found this session helpful, and I will see you guys again next week. Thanks, everyone. Bye.